absolutely no chance that you would have been able to predict then what was a 1.5% sell-off ending the day as almost a 2% gain. And this intraday market volatility on this equity market, to me, just highlights how much uncertainty it is. Look at these patterns. Right now, I'll take the pivots off and try and make this a bit more clear. Look at these patterns that we have intraday on these equity indices. 1% lower followed by 1% higher, 1% lower followed by 1% higher. This is absolutely our type of market in terms of volatility with this type of time frame that we're staying in trades, but it's a very difficult one to manage. I'm surprised there was quite such an appetite of going long. We can all understand why there are buyers in the market in the S&P with interest rates being put off more than a small degree. But in my opinion, what we've seen over the last 2 and 3 weeks is that shift in that looser monetary policy no longer means a Pavlovian response to buying risk assets, but actually a slight change in behavior has meant that looser monetary policy allows people to think, well, why is this looser monetary policy still needed, and therefore what reasons do we have for concern on that? But that bounce back in the S&P, you must feel sorry for any traders around the world, and I'm sorry if there's any in this room, but you must feel sorry for any traders around the world that didn't get involved on that initial market sell-off on the S&P, and then thought, and perhaps justifiably so, then thought, well, I'll wait for a retest of the pivot level in the afternoon, and I'll put my shorts on here and have my stop above the pivot level, or even just have a longer term short position after that data, and then once again getting ironed out, trying to hold longer term positions on these equity indices. Very, very hard to know where these equity indices are going in the medium term. But what you see here, if now I've gone back out to a daily chart on the S&P, what you see here quite clearly, let me just go to a continuation version. What you see here quite clearly is there's the big market move, there's Black Monday, okay, and since that, since that strong move lower, we've had this period of consolidation. It doesn't mean the move lower is over, almost far from it, in my opinion. And actually the FT has quite a good example of this, or certainly quite a good review of this, saying the fact there hasn't been a further move lower should actually be cause for concern. We've not yet had that type of correction that a strong fundamental rebounds can be made from. All we've got here is just an oscillation between 1900 and 2000. That's the range, really, isn't it? That's the range we're looking at, 1900 to 2000. Yes, 1880 really is that level to keep an eye on after 1900. But we just have this very wide range now in the S&P of consolidation after that sharp move lower. In my opinion, the fact that the Fed, there's no way the Fed are hiking in December, in my opinion, no chance, unless the October non-farm payrolls comes out 300,000 and last month's number gets revised up to 50,000, no chance. What we saw, the beginning of this market sell-off was really when the Fed delayed that September hike. And I don't think the fact that they're not going to be able to hike in December is good news either. So we'll have to see. Also, in research sent to you from the FT, they're talking about a reversion, in terms of we're about to start the equity earnings season once again, and expectations are low. Really, expectations are low on the profitability of the firms within this S&P 500 index, thanks to a slowing China and a slowing global economy. I'm still biased to the downside. I wouldn't be surprised if we have, we retest 2000, we have noise around this level, but if and should we break 1880 again, that's when I'm going to be selling. Unlikely I'm going to be selling around here. I don't mind whether I'm going long or short, but should we break 1880, then it'll almost look a bit like, and we've looked at this before, if you go back down to the dot-com boom, you go to a daily chart, let's just move that onto a continuation, and let's go back to similar charting pattern here. So this is how markets move in bubbles, okay? As a clear example, this is the dot-com boom, very similar to how we've seen equity markets move, albeit over a longer period of time. You've got the low, that's the summer low, if you like, being tested at 3106. Can you see how this is a similar pattern to the S&P now? So you got the low, we've then come down to retest that low, double bottom, strong push higher, everything's looking rosy as you go towards the December period. October, test, and then it breaks through it. And once it breaks through that first summer test, that's when we really get the trend lower and lower in that equity indice. Not too dissimilar to what we've seen now. Not too dissimilar. So this push higher in the S&P, I mean, look at that. This push higher in the S&P, okay, it's taken longer, but I don't think it's too dissimilar in terms of behavior and in terms of pattern. And should we get below 1880 again, that's really well be selling. But that's the equity market. The equity market on non-farm payrolls is always a little bit convoluted. It's quite tough to actually get hold of anything on the non-farm payrolls data in the equity markets. What was more impressive by leagues was the currency space and the T-note space. I don't know about you guys, but I had no chance getting on this long euro US dollar. I was not quick enough. I was doing on a slightly different keyboard, but I just wasn't quick enough to get stuck into this long euro versus USD. This is dollar weakening across the board, and there was no real retracement during the whole of Friday. Actually, if I go to a 90-minute chart, I was looking to see if there was going to be a potential entry on the trend line lower in the euro US dollar. But no real retracement there. Although, yeah, I mean, there it is. To be fair, we only went back to touch the lows on Tuesday the 29th. We went back to September. We passed that mid-September handle and went back to test the lows of sort of September the 14th, 15th trend in the euro US dollar. So that head and shoulders, I would definitely keep an eye on your chart. Can you see that head and shoulders pattern from Thursday the 17th, Friday the 18th of October? This level here, it's around 130, it's around the 130 handle really, but I'm just going to push it higher to take into account that spike on the Thursday the 24th of September. So here we go, there's that key resistance level. We just couldn't hold ourselves above it, 1.1311. And what's interesting as well for me to see is that on Friday afternoon, the euro US dollar kept on losing ground. And what's the correlation here between equities and the euro USD? This was one of the signals, or you could have traded this. I wasn't trading it that afternoon, but you could have traded that in terms of the inverse correlation. Equities then having a strong reversal higher and the euro USD being weighed on, moving lower. So equities sharply lower, then a sharp rebound into the afternoon. Euro US dollar sharply higher, then a rebound lower into the afternoon session, although we are now finding some of those gains again in the euro USD going back to Thursday's high. What about T-notes? This was definitely an impressive move again. Could not get hold of that, but that looks like, just from my bare eye, that looks like a decent Fibonacci level in terms of where we did end up finding support after that sharp move higher. Did anyone actually manage to get onto T-notes at all? Unfortunately, I know I did not. It just, the way it moved was pretty ferocious. And if you didn't, it's fine, because if you did, you would have been taking quite a risk, I think, because you would have had to have been buying the highs of these moves. The momentum pushing higher. What you didn't want to do, the reason why those of us who managed to keep our trading discipline, the reason why we didn't want to get long is we didn't want to buy levels like this. We didn't want to buy those upper levels only to then have missed the boat. But T-notes now testing their pivot level. It'll be interesting to see if this comes in as support going forward for the rest of the day. So T-notes back onto their pivot levels. Last one to talk about, I've been talking about it, is gold, 2.5% higher on the day. Just consolidate. This is the weekly confirmation chart on gold, continuation chart. For bulls out there, or if you want to be slapped around the face with the wet fish and you're a gold market bull, just have a look at this chart on a weekly chart. That trend is certainly lower, isn't it? We do have a series on the weekly chart. The trend since July has been of higher lows. That's definitely true. So July, August, September, we've had 3 months of higher lows. But looking at a slightly longer term chart, no, definitely that still looks bearish to me. I have to be honest. I'm hoping for something different, but just saying what I see in the chart. There's the move higher on Friday. And here you can see that I've got my trades on gold over the week before. Every time I'm going long gold, I pretty much scratch it in the end. I am a gold bull. I do think there's more reasons than not to go long gold. And Friday's number just confirmed that point of view. But when you look at this product on a weekly chart, the trend certainly is lower. But a very strong day in gold on Friday, and those gains being held on so far. So what's happened this morning? Well, we started off really continuing in the same vein as we left Friday, and equities are bullish. If we look at the DAX, for example, since the market opened, where we gapped higher in the DAX, you would never have thought that, if you left the desk at 2:30 or 3:30 on Friday, you wouldn't have thought that the DAX would be trading up towards Thursday's highs by the time you turned on your screens on Monday. I just want to reiterate, this is exactly why we trade with the time frame, with the time scale that we have. You don't need to be able to predict the future. If you're out of your trades in the evening, if you're trading momentum, if you're trading opportunity when it happens, you don't have to be able to predict the future. You can react to opportunity as it comes. So I'm going to be interested to find out your views, guys, on Friday's figure and where you see trading opportunity coming from us as a result of that. For me and for us, I think it's fantastic. It means we're going to have a really interesting October. And October can be quite a difficult month for equity markets. If you go back and historically you look at how equity markets have performed in October specifically, it's not always good. And we've certainly made life tougher for these October markets. Now, just to talk about other news away from the non-farm payrolls figure, really about politics. Politics all over the place, really. You've got Europe now bending over backwards to try and be friends with Turkey and Erdogan in order to try and solve the refugee crisis. Not necessarily the best thing for the region at all, certainly from Cyprus's point of view. You also have tension then just the other side of Turkey in terms of Syria, as Moscow are really sticking their oar in when it comes to the no-fly zone in Syria. Almost impossible now. EU and the US, it's one of the reasons why these decisions, when they take so long, the dangers of procrastination, but apparently the EU and the US were just a hairbreadth away from establishing a no-flight zone in Syria, but the fact that Russia are now involved in that Syrian airspace makes it absolutely impossible for them to do so. This is totally a thorn in the side of the West, and really the FT here is saying that it describes a Putin worried about his own popularity in Russia as the appetite, or certainly the euphoria over the Ukrainian situation, seems to be waning. The average Russian's attention is now focusing back on low oil prices, on the faltering economy, on the bad employment data and the bad life prospects there in Russia. As attention turns to that, Putin needs to do something, once again, to wow the crowds, if you like. And this is it. This is it. Showing the West that he's also involved in Syria and his wishes need to be taken account of. It's an absolute power play. And I said this about 3 months ago. The West should feel much more comfortable with a strong Putin than a weak Putin. A strong Russian leader is much better for everybody than a Russian leader that feels they're losing their power. Because if you feel you're losing your power, then you're going to be taking action like this in order to try and re-establish it. So, I wonder if this is another reason for going long gold. This new tension between Russia and the West. It's not come to anything yet, and let's all hope that it doesn't come to anything. But it certainly doesn't help calm the region in those areas. Of other news then, so that's on the political front. You've got Turkey with the refugee crisis, Europe trying to bring Turkey closer and ignore perhaps the potential civil war that's happening in Turkey. You do have a civil war going on now in Syria, where the West now faced Russia. The US internally has its own political headache of monumental scales. I'm very sad to say that last week in the US saw one of the strongest weeks of gun sales, weapon sales, that's ever been seen in the United States, after the college shootings again, as then Obama goes on. I mean, of course, Obama's trying to do the right thing, in my opinion, here by then going on and saying we have to do something, we have to limit gun sales. Actually, the exact effect of that is to vastly increase gun sales in the near term, as people think that reforms are going to be brought in, and anyone that then doesn't have a gun wants to get a gun straight away before then laws are changed. So US gun firms far exceeding every other type of company last week in the S&P after that shooting, the absolute opposite perhaps to what Obama would have liked to achieve, and worrying news indeed. In other news then, Glencore, that's an interesting one. In Asian shares in the Hong Kong market, Glencore surged 71% overnight. Glencore surged 71% overnight. I am a victim of the own behavioral psychology that I tell you guys all about here. I got out of my Glencore on Friday, having been able to ride the bounce on Tuesday. It went okay, but I got out just to say, right, it's such a volatile stock, I'm going to be risk averse here. Perhaps it was the right thing to do. Perhaps I should have left a bit of exposure on. Well, obviously I can say that in hindsight. Obviously now it's up 71% in the Asian equity share trading market. But the big news here is that the board of Glencore say they would be open to a takeover. They are open to a takeover of the company in whole, and therefore the share price coming back to reflect that. Last piece of non-financial news, therefore, before we look at the calendar ahead, is the brands either cheering or woeful about England's dismal performance in the World Cup. Absolutely outplayed in every single way were England, so I'm not actually too sad about us being out. Thoroughly deserved. We were appalling, and kind of a reflection slightly of nepotism, you could say, where the fly half's dad is the back's coach. That does hamper the selection process, of course. But here we're talking about companies that are winners and losers of England pulling out. Well, certainly the biggest loser is probably O2, that's changed their logo to the England Rose for this World Cup. That's handed out 3 million rugby shirts with the O2's logo as an England Rose. That's been projecting the England Rose on the Millennium Stadium. They're going to have to rein that in slightly. Also, of course, any advertisers that have paid for the slots that might have a lower English viewing. But one thing I've noticed about the Rugby World Cup, though, is, I went to see Romania versus Ireland at Wembley, and it was an absolute sellout event. I don't think the fact that England aren't in it is going to change that too much, which is a good thing for the sport. Okay, so let's have a look at a week ahead coming up. What have we got? So this morning we've got some UK data in terms of market services, PMI, real only minor release to be honest. Retail sales coming out of the EU, that's coming out at 10 o'clock our time. Then 2:45 we're looking at US data. It's going to be a muted day, to be honest, guys. I have to admit, it's going to be relatively quiet today, as you quite often get on a post non-farms day to day. Just looking forward then to Monday overnight. If you are trading currencies, you've got the Royal Bank of Australia interest rate statement, and that is interesting, given how the Aussie dollar has traded in the recent months, heavily down the Aussie dollar, of course, after the slump in commodities, and real concern for the Australian commodity on the slowdown of China. So that's really looking forward to tomorrow morning. But for the rest of today, the data's really relatively muted. I'll obviously talk to our analysts here, but it's likely we're going to be looking to try and go with the momentum in equity markets today. It doesn't sit well with me. It doesn't sit with my long-term view going long equities, but you can't really argue about the rebound on Friday and the push higher so far this morning. T-notes now breaking back down below the pivots as these equity markets continue to bounce higher. As I said, I'm going to be interested in your point of view here, guys. Whether you think this bounce in equity markets, what are the reasons for it? Do you agree with those reasons? And how sustainable could this be then if the Fed don't hike this year? Are we getting perhaps people saying, okay, maybe this is now a positive once again? Who knows? But really in the equity space, it's a mess, to say the least. We've had composite PMIs out this morning already, out of Germany and out of the EU as a whole. So a slight miss from Germany. PMI September 54.1 versus 54.3. The pound extending its gains this morning, so that's going to be interesting looking at the currency space. Even if you think the equity space is mixed and hard to manage, cable has staged a recovery this morning, but do be careful buying anything BP6 like. I mean, this recovery, all you have to do is scroll back in the chart over the last 2 weeks to see where we've come from. Really, since mid-September, the pound has been one of the worst against the US dollar. So it's down almost 3.6% versus the US dollar since mid-September. So the pound taking a real hit. Of course, we're getting a bit of a bounce now as there is dollar weakness coming back into the market. And just think about this in terms of assumptions that have been made. You know, and the FT talk about this in terms of assumptions that have been made that really need to be reassessed. Assumption number one, monetary policy and loose monetary policy can help revive equity market prices. As you've seen, that has been beginning to change. The psychology of that's been beginning to change. Assumption number two, that the growth in China is going to be strong and going to continue to support the rest of the emerging market space. That assumption's being taken out of the picture. And assumption number three, that the US economy is going to continue to generate jobs. You know, these are big assumptions of the end of 2014 and early 2015 that meant we'd get dollar strength, that have led to equity prices moving higher, that have led to growth expectations moving higher. All of those assumptions are now being put to the test, and it's a worrying time for the global economy. It's an especially worrying time because when they had the chance, interest rates were not changed, and so we've got no ammunition to fight a perspective turned out. Well, that's it. I'm beginning to sound a little bit too bearish, so I'm going to stop the morning briefing before I start to believe my own biases. I recommended a book, by the way, last week, Misbehaving by Thaler, won the FT book for 2015 book review. I'm going to share the link in the room again. I've been reading it over the weekend. It is fantastic. Who here has read Thinking Fast and Slow by Kahneman? You read Thinking Fast and Slow? If you have, or if you've tried to and you felt it heavy, I mean, I love Thinking Fast and Slow, but if you're not in tune with behavioral economics, or if you don't have experience in that area, then it can be quite a tough one to swallow. I would say this book by Richard Thaler is a lighter one to read. If you struggled a bit with Thinking Fast and Slow, this is a more introductory book to behavioral economics. If you can get hold of a copy, the book I bought had to be nearly good as new. It was a damaged book because there was no new books available to buy. It's absolutely sold out. Try and get hold of one. You can get it on your Kindle, of course. It's quite light-hearted. It's a good read, and it's just looking at how inefficient we are at making decisions and really concentrating on that massive factor. How do people feel? How do people feel about their performance? How do people, weirdly enough, so he was saying he's an economics tutor, and his students much preferred getting 97. So this is the book Misbehaving by Richard Thaler. His students much preferred getting 97 out of 137, for example, versus a higher mark of 70 out of 100, 70%, because they got 97. Even though it was out of 137, how strange are we in terms of being able to reflect on our performance, and how inefficient are we at making decisions that are monetary based rather than emotionally based. And I love this kind of stuff. So I've not finished it yet. I've only had it for a couple of days, but you can fly through it, and I fully recommend everyone, if you're interested in behavioral economics, do order it. Misbehaving, Richard Thaler. We'll get a few copies for the office as well, of course. Okay, guys, that's it for this session. Look forward to working with you in the room. Take care, and hope you've had a refreshed weekend and you're ready to go. See you in the room. Bye.